Time now for Money Power Politics. The Dow surged more than 1,000 points today, and the S&P posted its best day since May on hopes that the Iran war could be reaching its end. Those hopes were fueled by a new report from the Wall Street Journal, which said that the president has told aides he is willing to exit the war without reopening the Strait of Hormuz. Now, to be clear, that strategy might quickly end the war, but it would not actually end the ongoing crisis in the oil market. The price of Brent crude oil has soared more than 60% this month. That is the largest monthly gain in nearly 4 decades. Top economist Mark Zandi warned today that oil prices would only need to average about $125 per barrel in the second quarter of this year to trigger a recession. Zandi's warning has been echoed by a growing list of executives who fear that markets have perhaps underestimated the impact of this energy shock and warned that recession risks are growing. Dan Nathan joins me now. He is a CNBC contributor and co-host of the Risk Reversal podcast, and Rohit Chopra, former director of the Consumer Financial Protection Bureau and a key advisor to Democratic state attorneys general. So, Dan, I want to start with the stock market today, and maybe you can explain it to me, but I do not understand why market participants keep on, in my view, falling for Donald Trump saying, oh, it's going to be over soon. Don't worry. It's going to be done in 2 weeks. Like, even as we are doing things to escalate the war, sending more troops over, sending B-52s, et cetera. So why is this the reaction from markets? Am I crazy for not getting it?
Well, today was really unique, and the power in which the market rallied was something that I think it caught a lot of market participants, kind of off sides a little bit. And it was also coupled with the fact that oil did not come in a whole heck of a lot. Like you just mentioned, where Brent crude was, WTI, obviously, which trades here, are reflective of, the oil markets here, is still above 100 a barrel. So what we've seen over the last few weeks as this war has gone on, when oil goes up, stocks have gone down. But it's done so in a pretty orderly fashion. Friday afternoon, the market closed down nearly about 10% from its recent highs. And that's something what kind of gets you into correction territory. But we talk about this all the time. The market is one way to think about what's going on as far as the economy is concerned, but they are not the same, right? The economy and the markets do two different things. So if you're talking about the raging market that we had today, I think it's somewhat reflective of the fact that sentiment got really poor in a very short period of time. People got really dour about the markets, and they're kind of hearing all this stuff. Price at the pump, it's, gone up $1. It's not just that. I mean, it's also when you think about what are some of the other expenses that folks are going to have to deal with. Diesel, for instance, has gone up a lot, right? So a lot of the goods that we buy are shipped or actually moved around with diesel fuel. And in California, which is the 4th largest economy in the world, right? You got the U.S., then you got China, then you got Germany, then you got California. Diesel prices have gone from about $5 to over $7. Those increased costs are going to be passed on to consumers, not just the price at the pump. So when you think about all that cumulatively, it wasn't a great setup coming in, and you get some sort of sense that maybe we're going to get some sort of relief from the war. I think people are immediately imputing the fact that maybe those costs or those prices are going to come down. And I think that was kind of the real driver here. But to your point about why are investors falling for this thing?
Yeah, everything you're telling me makes it sound like markets should be doing worse,
right.
Not that they should be elated by.
Right. Well, we've seen 1 step forward, 2 steps back. Today it was 2 steps forward. Let's see how far we go back if we see some of these tensions start to pick up a little, and we don't see really a follow through with some of the rhetoric that we've heard over the last couple trading days.
Rohit, the Islamic Revolutionary Guard has also threatened to target U.S. tech and defense companies in the Middle East at this point. That includes Apple, Google, Meta, Microsoft. Those are the biggest companies currently underpinning the U.S. economy. What do you make of these threats?
It's hard to know what the rhetoric is from this new regime, but I think the markets actually have made a little bit of a shift. I think many on Wall Street were thinking the U.S. may not be losing this war, but it's not winning the war either. And people wondered, how long is this going to be drawn out? But this may be like tariffs again, with Trump chickening out and maybe backpedaling, backtracking, and maybe that is leading to some shift in sentiment. But I'm really worried, and Dan mentioned this, we are not seeing those key indices all of WTI, all of them, they are not falling below $100 a barrel. And that is going to have just a real effect, not just on people paying for gas at the pump, but the inputs to manufacturing so many goods in the economy. There will probably be more threats to big US firms, and we will see how that plays out. But I'm pretty worried about where things are going. And just like the tariffs that we saw, some of those price increases hit months later, we may be in the same situation when it comes to our energy supply here at home.
So, Dan, Rohit made the analogy to tariffs and the taco trade, Trump chickening out. It's a little bit harder for me to understand what it would even mean for Trump to chicken out here, because as we were saying, even if the war ends, that doesn't necessarily mean that this choke point in the Strait of Hormuz reopens and that oil markets go back to normal. And in fact, multiple sources have told Politico that Trump officials are discussing the possibility that oil prices climb to a record $150 per barrel. The same story suggested that they haven't ruled out the possibility of prices rising as high as $200 per barrel. So we should note that this is not necessarily the baseline forecast, but what would happen if prices got that high?
Well, I think that you'd see a little bit of a panic in the near term, but I think if you go back in history and you look at these sort of price spikes, you'll see it come back in fairly dramatically. That doesn't mean it's going back to $65 a barrel where we were about a month and a half ago. And there will be a risk premium built into oil when you think about no matter what it is. If it's a ceasefire, we just don't know how that ends up. We don't know how the Israelis are thinking about it. We don't know what sort of commodities are moving through, let's say, the Strait of Hormuz, like you talk about, and what sort of speed in which they're doing it and getting back to sort of the pre-war sort of levels, that sort of thing. But, it's not just you can cancel tariffs, which is what happened. That's right. The taco trade. You try to cancel a war. It doesn't kind of work that well, right, if you think about it. So, we're in a position where a lot of CEOs are going to look at what's going on. They're going to look at the uncertainty. They're going to look at the uncertainty of the policy coming out of the White House. And they're going to say to themselves, how much are we going to invest in our companies? How much more are we going to be hiring, right? If we have higher input costs, we're going to have to pass it through to consumers, right? So that's the sort of thing that could keep the economy somewhat on its heels a little bit. So when you hear Mark Zandi talking about the probabilities of going to a recession, those expectations for higher prices are the likelihood of really an economy that's not going to be accelerating anytime too. And when you think about the potential for price spikes, whatever it is, whether it's oil, whether it's helium, whether it's other input costs that are going to be in shortages, that's the thing that really causes uncertainty about corporate America.
Rohit, before we go, I do want to ask you about another story that popped up recently about Defense Secretary Pete Hegseth. The Financial Times reports that Hegseth's broker looked to buy a defense fund right before the U.S. attacked Iran. We should note that a chief Pentagon spokesperson has called this allegation, quote, entirely false and fabricated, unquote. White House Deputy Press Secretary Anna Kelly called it a nothing burger story to smear the Trump administration. What is your reaction to this reporting?
Well, we've already seen lots of evidence, and I'm really looking hard often at these prediction markets about where there are trading opportunities for when people have inside information about national security. And, this may be one incident. I don't know all the facts of it, but it feels like it is a consistent pattern where there is a coterie and clique of people around the president who are looking to get rich off of the inside info that they have. We saw this apparently with Scott Bessent and the Argentina bailout that he did. We have seen this on all sorts of issues related to foreign policy, economic policy, tariffs. So I think that this is really one of those questions where what is the goal of economic policy that they're pursuing? Are they being tilted by enriching themselves? And that is not what a country like the United States should be.